Upside surprises have continued to come in across the board in U.S. economic data. Things like forward-looking indicators around the services sector, ISM PMIs have been quite strong. And also on the consumer side, we've just seen continued resilience coming from things like retail sales. So kind of putting it all together, we see just an economy that continues to kind of chug along and chug forward in a really healthy way. And I think importantly for the overall outlook is, we've seen a little bit of weakness in the labor market, but not too much. And so we're kind of getting that Goldilocks sort of soft landing that really the market thought was impossible to happen at the start of this year is really starting to kind of come through in the economic data in the US. As we look overseas, things are a little bit different. We've been highlighting for a while now just the disappointing reopening in China. And while we've seen some stability in those numbers recently, it hasn't really translated into an economic inflection that we can get behind. And furthermore, we often think of the European economy as being highly levered to the Chinese economy through export and trade channels. And we just have not seen that come through in European data as well. And so kind of bottom line, putting it all together, continued economic resilience in the U.S., driven primarily by the consumer and the labor market. And the U.S. is really the growth engine for the rest of the world. We don't see that coming, from across the board. And so that continues to kind of inform the way that we're thinking about the forward-looking indicators and what we're monitoring from an economic perspective. So we have a Fed meeting coming up in a few days here, and widespread expectations in the market, and certainly we share those, is the Fed's going to do nothing. They're going to be on hold. I think the question is sort of what things look like for the rest of this year. And so, in that front, the inflation story that we've been highlighting has been very favorable, for the last couple of months, really this entire year. It's definitely facing a little bit of headwinds today. The August CPI print was a little bit on the hot side. That's one higher print when we've had two good ones. And so no cause for concern yet, but something that we're certainly watching, especially, in light of the fact that crude oil is above $90 a barrel and up, quite strongly over the summer. And so, really, as we think about Fed policy, it's really coming down to kind of where we go on the 2024 basis. One more hike, if we do get one at the end of this year, that really doesn't matter when rates are at 5.5%, but it really kind of matters the duration of interest rates being high. And so we're going to be listening to kind of Fed projections and Fed speak, but really listening more to what the economy is doing, because at this point in the cycle, it's much more about economic performance than it is about what the Fed thinks or what other central bankers think. So in our equity portfolios, we favor the U.S. and a lot of that's about the economic resilience that I was mentioning earlier. Within the U.S., we like growth and large caps and quality, and so that's some of the tech and AI related trades. And also communication services, some areas that are kind of adjacent to that overall theme. That's one that's been going on in the market for quite some time. But we do like a couple other areas that are a little more idiosyncratic. They're kind of tangential to those exposures. And the one area internationally that we like, even though we are underweight overall, is Japan. We see a lot of really nice things. We've talked about it, for the past few of these updates. And we continue to see some really nice risk reward in that segment of the market. And also, as I mentioned, energy prices being up, and as we push back this kind of recession that everyone's expecting, and we don't see that on the horizon in the near future, energy companies are earning quite a lot of money. And so that's another area that is a little bit different than the AI theme that we've been talking about, but we do think that's a nice opportunity to have in a diversified portfolio. On the fixed income side of things, as we think about economic resilience, we think about companies that don't need to borrow that much because they termed out their debt in the low interest rate COVID period. That's just really a kind of an overall favorable backdrop for credit markets. And so, we have broad-based exposure across investment grade and high yield markets. Certainly that's been kind of a theme within markets, and we see that continuing, in the near term. As we sit here today and we turn towards the fall months and we start to think about, potential volatility that we do see, seasonally in this time of year, and also just trend changes in general as investors really start to hone in and focus, on kind of where they want to be allocated and putting money to work into the end of the year and into 2024. We do think that we're in for some volatility and some potential trend changes. And so within our portfolios, we are maintaining some kind of lower volatility tilts within our equity side of things in case things do get rocky. And on the fixed income side of things, we are maintaining a little more liquidity than we would normally. And all those are just kind of a precautionary type of situation where we do have potentially volatile markets. And in that kind of situation, we would be able to take advantage of opportunities that may present themselves across fixed income and equity markets. As we look forward, I think that theme of economic resilience, and especially in the U.S., is going to continue to inform our positioning. But at the same time, we do have to be attuned to the risk, right? This does tend to be a period of the calendar where we see a lot of trend changes, elevated volatility, and it can be potentially difficult for markets, especially if we start to think about some things we haven't thought about in a long time, like maintaining interest rates up here for the extended periods in 2024. Or seeing a potential bit of resurgence in inflation because of that economic resilience. And so because of those reasons, we're keeping a little bit of kind of more safety within our allocations to be able to potentially take advantage of opportunities that could present themselves over the coming weeks and months. And so on the equity side of things, that's some lower volatility holdings that tend to move around less than the overall market. And then in the fixed income side of things, credit spreads are quite tight, and so we're maintaining some liquidity within those portfolios as well.